Let's continue with Chapter 8. You can see here we've got a stock repurchases. We talked about that. A few of the key reasons why you would do that. Also, just know that stockholders don't have to sell their shares because sales are realized capital gains or subject to capital gains taxation. That sometimes when a company is trying to buy shares off the market or buying them from individuals, sometimes individuals don't want to sell because they don't want to realize the capital gains and pay the taxes. Preferred stock is on page 280, a little bit on 281. It's superior, quote unquote, to preferred stock, and the reason for that is you're kind of more in line or first in line for certain things. You have a few more preferences than you do over common shareholders. Typically, it relates to dividends, and you typically get a fixed dividend that does not go up or down, and you get your dividend before common shareholders do. So if there isn't enough cash on hand or whatever to pay all shareholders their dividend, preferreds are first in line to receive a dividend before common shareholders are. You have also what they call cumulative and non-cumulative stock. A cumulative stock basically means if my preferred shares dividend is not paid in 1 year, that it accumulates and I'll receive it in the future. Non-cumulative means if that dividend is not paid in any one given year, I forever lose it. Okay, it does not accumulate. Okay, the final part of the chapter deals with financial statement analysis. And starting on page 282, and working our way through the chapter. And on 282, they talk about a cross-section analysis and a time series analysis. And obviously, time series is comparing a firm's financials over time, whereas cross-sectional is basically saying, let's look at our firm, our company, at a single point in time, but in different financial statements in relation to each other and how those numbers look. Okay, so we're building on a firm's financial statements and trying to get a way to more easily understand what the numbers mean. It's used by both equity and investor creditors. I have done some seminars at banks where I have helped teach bankers, future bankers, how to analyze financial statements and what that would look like for them in terms of how do we take a set of numbers and analyze those and crunch the numbers in order to come up with an analysis that makes sense, is easy to understand in terms of granting credit to a business. Okay, so both sides look at these. It facilitates comparisons over time, and that's what the time series analysis is, or across firms, which is cross-sectional. Okay, always know that when it comes to comparisons, it's good to have several points to compare to. So if it's over time, quite often you might do 5 to 10 years. I've done some time series analysis for companies, and we go back 10 years and just see what those trends are of key statistics and key ratios and try to observe a trend or see where those numbers might end up projecting as we go forward. Cross-sectional means we're going to compare firms to each other or compare one set of financial statements to another within the same company. Okay. I'm pretty sure we all know what a balance sheet is and what a balance sheet shows us. There's a balance sheet on page 283. Assets equals liabilities plus equity. So we have a snapshot of a company's numbers based on a given day and time. Total assets, total liabilities, and the equity listed for that company. And they show a 2-year balance sheet there on page 283. The income statement shows revenues less expenses to get down to a net income number. They show us a very abbreviated income statement on the top of page 284. Okay. Then the rest of the chapter, what it does is it takes a series of ratios and it breaks those down into smaller sizes. And those ratios then can be used to analyze a number of things. They categorize ratios into various groups, the first group being liquidity ratios. And liquidity meaning how liquid is this company? How quickly can we turn it into cash? So using the numbers given to us on the financial statements on pages 283 and 284 to compute the current ratio. Current ratio is very simple. It's current assets divided by current liabilities, and we get a number. And you see it's 1.74. So what that means is that for every dollar that the company has in liabilities, there's $1.74 of current assets to cover that. So it has plenty of current assets on hand to cover and pay for its current liabilities. And obviously, the higher that particular number is, the better. Whenever you look at a ratio, keep in mind that it's best to compare it to something. So I'm looking at this and I see a number, which obviously has some meaning. It's good to have a number there. But that number is more meaningful when I can compare it to something. So that 1.74 has more meaning when I can compare it to several years of my company's data historically, when I can compare that to a key competitor or an industry average. Then that number has more meaning. A quick ratio is basically current assets minus inventory. So basically assets that are already cash for the most part, and then dividing that by current liability. So it's going to be a little bit lower number than the current ratio because our asset number is lower. Activity ratio is this information. So current ratio or quick ratio is on 286, and then activity ratios are measuring basically inventory for the most part, and inventory receivable and turning accounts receivable into cash. And so in this example here, you see inventory turnover. And we get a number as we do this, sales divided by average inventory, and we get 10.3. Basically tells us how quickly is inventory being sold. How many times do we flip over our inventory during a year? Basically that process of buying inventory, filling the shelves, selling it to customers. That inventory turns over 10.3 times during the year. Okay, so the higher that number, obviously, the more profitable we probably are. But also keep in mind, retailers will have inventory turnover, right? But different kinds of retailers will have different inventory turnover ratios. A Walmart, a grocery store would have a very high ratio, whereas a automobile dealer or a farm implement dealer would have a very low ratio. And so you can't compare them to each other. So it really, but this does facilitate comparing one company to another within the same industry. So if I'm comparing Walgreens to Lewis Drug and I'm looking at this 10.3, I would want to see, are they fairly similar? They're doing the same kind of business. They're both selling pharmaceuticals plus other things. So 10.3, if they're about the same, that might make sense. If one's higher than the other, I might ask questions why. Okay. Average collection period just basically says how long does it take for us to collect our receivables. We do the math here and say 23.7 days, so almost 24 days for a receivable to be collected. And that's one where we don't really know if that's a good number or a bad number until we look at what is our average credit terms when we sell on credit. Is it 30 days? If our credit terms are 30 days and we're averaging 24 days, we probably feel pretty good about that. Okay, that makes sense in terms of when we collect and how we collect. But if our credit terms are 60 days, or I'm sorry, 15 days, everybody's past due, right? So that's not a good sign. So we have to look at that and compare it to our credit terms that we sell on credit to with our customers. Receivables turnover is how quickly do our receivables turn over? How often does that process of turning our receivables over happen? 288 and 289 is where we show some of those ratios. Fixed asset turnover, basically, what percent of fixed assets turn into sales? So in this example, 3.9 is the answer. For every dollar of fixed asset, we've got $3.9 of sales. Okay, and so it's basically saying how efficient are we at using our assets to earn revenues. Asset turnover is taking total sales divided by total assets, kind of the same one as the ratio before, only now we're including all assets, not just fixed assets. Then we've got some profitability ratios, and the profitability ratios are on 291. Our gross profit margin, sales minus cost of goods sold divided by sales. And basically, what's the markup? If we sell a good for $1, basically it means 41 cents or rounded 42 cents is gross profit, and 58 cents then becomes cost of goods sold. That's one way to think about that. So for every dollar of sales, how much turns into gross profit? Profit margin is basically just taking our operating earnings and dividing it by sales. So for every dollar of sales, I have pre-tax earnings of 17 cents. Okay. So it tells us how profitable we expect to be. The net profit margin is basically the net income, earnings after taxes divided by sales. So for every dollar of sales, 10 cents is pure profit, the very bottom line. Return on assets. How good was I at using my assets to have earnings? So my earnings after taxes, the bottom line of my income statement, compared to total assets available. For every dollar of assets, I had 14 cents of earnings. Same thing with equity. How efficiently was I at using the equity of my business to earn equity? And so earnings after taxes divided by equity gives me my return on equity. That's a really high number right there. Typically, you might see that be more in the teens for a company. Return on common equity is basically adjusting out preferred equity and just saying, let's take common equity and can turn that to earnings. If there is no preferred, it's the same as this ratio right here. If there is preferred, we just simply back out the preferred equity and use the same formula. Then we have what they call leverage or capitalization ratios, and a debt ratio and a total or debt to total asset ratio. Debt ratio is debt divided by total assets. Let me say that right. Basically, how much debt do we have in relation to total assets? Okay, so in this example, we've got debt of 3.5 million, total assets of 4.4 million, 80%. That's a really high number. So what that would tell me is that this company is very highly leveraged, that they've got a lot of liabilities compared to their existing assets. That's a key number that a lot of banks will look at when they're trying to figure out if they should give a company a loan. They want to see what they already have on the books for loans, because if that number gets too high, there is potentially not the ability to pay that back. Debt to equity is basically saying how much debt do we have in relation to our equity. Again, that's a really high number for this particular company here. Coverage ratios times interest earned. Some of these ratios here on the bottom are on, I should say, on page 296. Earnings before interest and taxes divided by interest. In other words, how much more earnings do we have than interest that we have to pay? So this measures the ability of a firm to pay its interest obligations. So ratio comparisons, like we can go through and do an analysis for a company and crunch all these ratios and determine what they are and see these numbers. But what really makes more sense is when we can compare these ratios to something. If it's history of within our one company, or if it's comparing one company to another within the industry. Target to Walgreens. Or, I'm sorry, Target to Lewis Drug, or Target to Walmart, Lewis Drug to Walgreens. Companies that are doing the same thing but are key competitors. Other issue is that sometimes there becomes problems for interpretation. Some ratios can have different methods for how they're calculated. Historical data sometimes can be outmoded and maybe not very reflective. Sometimes we have to be aware of accounting changes and how those affected financial statements. Plus, keeping in mind that sometimes companies have a one-time non-recurring item that could make the numbers look very bad in one particular year, which hurts comparability over the years. Different kinds of creditors emphasize different ratios. The ability to repay interest and principal is the key factor that creditors are looking at. Obviously, if a creditor makes a loan, they want their principal back plus all the interest that is owed to them. And stockholders are more concerned with return on equity, and that's really one of the bigger ones is what is that return on equity? And the higher that number is, the more attractive that the stock is. And also the ability to pay dividends and then the ability to grow earnings over the years. A statement of cash flows is really actually a very important document to take a look at also when it comes to financial statement analysis. And they started to talk about cash flows on 298 and 299. They show us the cash flow statement on page 300. And a cash flow statement is basically saying what are the sources and uses of cash organized by three categories: operating, investing, and financing. Okay, so sources are inflows, uses are outflows, organized by the three categories of operating, investing, and financing. And one of the key things that many people will look at on the cash flow statement is the cash flow from operations. So that cash flow from operations is basically saying here is the cash that this company generates or uses by doing what it's in business to do. So if we're looking at Target's financials and we're looking at its cash flow from operations, and we look at its cash flow from operations, we would expect it to be positive. So it's basically saying how much cash is generated by Target doing what it does, which is buying goods from suppliers, shipping those goods to their stores, and selling them to consumers like me and you. Okay, that process should be generating cash. If it's not generating cash, then they're in a world of hurt. So you want to look at that number and see if it's growing, what that has been over the years, and so on. Okay, so there's the three categories right there: operating, investing, and financing. Okay, so that is the chapter. There's a really good summary of all the ratios on pages 302, 303, and 304. And I'll probably give you more questions about those ratios more on the test than the quiz, but the quiz will have a few things about them also, so just be aware of that.